All right, so in this video, we are going to be showing or highlighting how does whole life insurance rates of return or internal rate of return or its return compare to other assets. Because you're going to hear in the marketplace, whole life returns suck. But the question should be asked, in comparison to what? In comparison to what? Because that's an important thing, because too often people are trying to compare an investment rate of return with whole life rates of return, and they're not the same asset class. Whole life insurance is a savings vehicle, so you have to be comparing it to other savings asset classes, savings accounts, CDs, money markets. That's its true comparison. It should not be compared to investments. Ironically, when you include an apples to apples comparison, which we'll talk about in this video, whole life insurance holds up very well against investments, though that should not be your comparison. Your comparison should be to a bank account, and we're going to go over how we can do that. So again, we're going to be using calculators today. These calculators are found at truthconcepts.com. If you want to access them, you can get them yourself by going to truthconcepts.com. But we're going to be comparing internal rates of return and how do we mimic that rate of return outside of whole life and inside, and who wins and what's the best option in place or a good result for where we should be storing our money, our cash, as a storage facility when we compare it apples to apples. As you see here, we're going to have a 36-year-old. We're going to go to 34 years out, so we're going to age 70 on this. We're starting in year one on the policy. You will see that we have 27,184 going into the policy. In year one, at the end of year one, we have 24,309. Year two, 27,184 goes in. At the end of year two, we have 50,000. So we're going backwards, and this is one of the issues people have with whole life insurance, is it does go backwards. In a future video, we'll discuss why we're going backwards in the first few years. But over the 34-year period, by the end of it, after have contributing 27,184 for the entirety of the time, we have just over $2 million inside of our cash value, so inside of the account. So what internal rate of return does that produce? It's a 4.10 internal rate of return for the policy. It's important to note when you're dealing with whole life insurance, rates of return are net. They're net of fees and commissions and all of that. So that's the actual return. There's nothing else coming out of it. This is the growth that you're getting inside of the account. It's a net return. So the question becomes, well, if I'm comparing this to a bank account, how well does the bank account have to produce to replicate this number in order for me to do that? So let's take a look at that. So we're going to put this number in here. So we put that same rate of return into this alternative account. Now we're going to look at the alternative account. And you're going to notice, again, you have $2 million. So for me to replicate it, I put that much money in. And even with, that's the funny thing about whole life, is if we go back, like look at the whole life policy, I put 27 in, I'm going backwards for the first couple of years. Not until year 4 am I positive. But look at the alternative account. They're always, they always get the 27 in, and it's always 27 in, and it's just growing. In order for it to match the whole life did, it has to get 4.10% every single year to get $2 million in it. The problem is with these alternative accounts is they are not tax advantage accounts, so they don't have the tax benefit that whole life does. As whole life is growing over time, it doesn't have to pay taxes, but this account, whether it's a savings account, a bank account, a CD or a money market account, it has to pay taxes. And so if you're in the 35% tax bracket, you're no longer going to match the 2 million. So the whole life will have 2 million at the end of the 34 years, and your bank account will only have 1.5 million in it because it had to be taxed along the way, and it doesn't allow it to get as much growth. So what that means is in order for this alternative account to match what the life insurance did, the alternative account has to get 6.31% every single year for 34 years, which is very unrealistic. That's not, right now they're up, but just last year they were below 2%, and some savings accounts are below 1% a year and a half ago. So we need to realize that the chance of this happening is very low. And so whole life insurance can fill that role of your CD money, of your bond money, of your money market money. Like, it should be your safe money, and it can fulfill that role really well. Now the question is well, how does it compare to like investments? So investments, again, you still have to deal with taxes. So let's take away that bracket and deal with more capital gains. So if you're in a 20% tax bracket on capital gains, never mind, we're not going to do that. So we're just going to leave it 35% and just know that some of these things are going to be capital gains. But the thing that happens with other people is when you're investing is typically you're using an investment advisor to help you access investments. And so you have to have a fee for that. And so just to be a conservative fee, like conservative's 1.5% is fairly conservative. To match that, to match what a whole life policy would do in the 35% tax bracket and with a 1.5% management fee, you're going to have to get just under 8%, 7.93% in that investment to beat what the whole life does. So the whole life competes very well even against investments, at least in my opinion. Like, I don't like to get 7.93% for a lot of people that just rely on stock market investing and things like that. Like, that's probably what they're going to land, but there's a lot of ups and downs and rides and valleys, and whole life can fulfill that role for you. And then you can be more deliberate about where you invest. Use those dollars to save taxes. Use those dollars to really invest in things that you know that are going to get a better return than this number. And you're using whole life as your storage, your savings account vehicle to access those more deliberate decisions down the road. I really like this graph because it shows it pretty well. So you're pretty much even. The yellow line is the alternative account. The blue line is the whole life insurance. Pretty much even, and then it dies off because of those management fees, because of those taxes. And then in addition to that, the whole life insurance has the death benefit the entire time, and that's what's being represented by this purple line, which if you wanted a death benefit and you didn't whole life insurance, you'd have to spend money on term insurance, and then the term insurance is another cost that's coming out of your investable dollar bucket, and it will even make this a even more dramatic number than just 7.93. I hope this video was valuable. It just shows like why is whole life insurance a great replacement for savings accounts, CDs, money markets, bonds, because it performs better than most of those things long term. And over the next 30 years, whole life insurance is going to perform extraordinarily well in comparison to those things when you look at the future of like projections and such. Hope this was valuable, and see you next time.